Carol retired at 64, 31 years as a dental hygienist in Ohio. She had $310,000 in a traditional IRA, a $180,000 CD at her local credit union, and about $22,000 she kept in a savings account for emergencies. Her financial advisor told her, when you move money between accounts, keep the transfers small so the bank doesn't make a fuss. So she did. 9,000 here, 8,000 there, spread out over 6 weeks. Then a letter arrived from her bank's compliance department. Carol was now under a federal structuring review. That review triggered a civil asset forfeiture hold on $19,400 of her own money. Money she had saved over 3 decades, for 4 months while it was sorted out. The thing that would have prevented all of it was one wire transfer and one sentence to the teller. Nobody told her that. Carol is not unusual. She is what happens when retirees who are doing everything right, saving honestly, following their advisor's guidance, trying not to cause problems, don't know about the federal banking rule this video is about. If you are retired or getting close, if you've ever moved money between your own accounts, received cash from a family member, sold a car or a piece of property, or deposited an insurance payout, you are exposed to this rule right now. Not people with offshore accounts, not business owners with complicated finances. You. This rule has no income threshold, it has no age exemption, and the IRS does not care that your money is clean. Today, I'm going to give you 5 specific things every retiree needs to understand about this rule, and the one mistake that turns a completely legal transaction into a federal problem. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Frank Dalton. I spent 35 years as a CPA working with retirees before I stepped back from the practice. Every week on this channel, I break down the tax rules, the IRS traps, and the strategies that protect retirees from the things your advisor never mentioned. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me get into it. Thing number 1. What the $10,000 rule actually is and what it is not. Let me start here because most people have half the story, and the half they're missing is the dangerous part. There is a federal law, the Bank Secrecy Act, that requires your bank to file a report called a Currency Transaction Report, a CTR, every single time you deposit or withdraw more than $10,000 in cash. The bank does this automatically. They don't ask your permission, they don't notify you. They just file it. Now here is what I need you to hear clearly. That report on its own is nothing. It is not an accusation. It is not an audit trigger. It is not a red flag. Banks file millions of CTRs every year. The overwhelming majority result in absolutely nothing. Depositing $12,000 from a car sale does not put you in any danger. It puts you on a list that almost no one ever looks at. Here's where retirees get into real trouble. Someone, a neighbor, a friend, a financial advisor who should know better, tells them, keep your deposits under $10,000 and you won't have to deal with that report. So they do. And the moment they do that, they have committed a separate federal crime called structuring. That is what cost Carol her money for 4 months. Not the size of the deposit. The pattern of the deposits. Let me put a dollar amount on this so you understand the stakes. Retirees who get caught in a structuring investigation, even when the money is completely clean, routinely deal with account freezes lasting 60 to 180 days. In 2023, the Institute for Justice documented cases where the average amount seized in structuring investigations involving individuals with no criminal record exceeded $34,000. Getting it back required legal fees that averaged $8,000 to $12,000. And that is before you count the interest you lost on frozen funds. The fix is the same in every case. Deposit it whole. One transaction, one paper trail. Done. Here's what most retirees don't know. The $10,000 threshold is not the line you need to protect. The pattern is the line. And I'm going to show you exactly what that means in the next few points. Thing number 2. The 3 transaction types that put retirees directly in the crosshairs. Here's the part that should bother you. This is not a rule that targets wealthy people or business owners. The 3 situations that most commonly trigger structuring flags for retirees are selling personal property for cash, receiving family gifts in cash, and consolidating accounts after a major life event. Those are not exotic transactions. Those are Tuesday for people over 60. Take Robert. 67 years old, retired electrician in Tennessee. He sold his base boat, $14,500, cash deal. His son-in-law told him to deposit it in 2 chunks so the bank wouldn't ask questions. $8,000 on a Thursday, $6,500 the following Monday. Robert's bank flagged the pattern. His account was reviewed. He spent 3 weeks on the phone with his bank's compliance department before it was resolved. No charges, no penalty, but 3 weeks of stress, 2 trips to the bank, and 1 very uncomfortable conversation with a compliance officer, all of which was completely avoidable with 1 deposit and a copy of the bill of sale. Here's what most retirees don't know. Banks are not just watching for the $10,000 threshold. They are running software that watches for patterns, multiple deposits across a short window, all landing just below a round number, particularly $9,000 to $9,900. That range is one of the most flagged bands in the entire system because it is exactly what someone who knows about the rule and is trying to dodge it would do. If you sell something, deposit the full amount. If a family member gives you cash, deposit the full amount. If you're consolidating accounts, move it in 1 wire transfer. Every single time, 1 clean transaction is safer than 2 split ones. And then there is the one that catches people completely off guard, because this one doesn't involve selling anything. It doesn't involve receiving anything. It's just you, your own money, your own accounts. Thing number 3. Moving your own money is not automatically safe. This one is the most misunderstood point in this entire topic, so pay close attention. Retirees consolidate accounts constantly. A spouse passes. You move from 2 banks to 1. A CD matures and you want to move the funds somewhere with a better rate. A brokerage account gets closed and you're moving the cash to your checking account. These are completely normal, completely legal financial moves. But if you move that money in multiple smaller transfers over a short period, even between your own accounts, the bank's automated monitoring system cannot distinguish your intent from someone who is deliberately breaking up deposits to avoid a report. It sees a pattern. It flags the pattern. The flag creates a record. Meet Sandra, 71 years old, retired librarian in Georgia. Her husband passed in February. She had accounts at 3 different institutions, a checking account, a money market, and a CD that had just matured. She wanted to bring everything to 1 bank. She moved it over several weeks in pieces because she was grieving, exhausted, and didn't want to deal with a complicated wire transfer. 6 weeks later, she received a written notice from her new bank asking her to explain the source of the funds. Sandra had done nothing wrong, but she had to spend an afternoon she'll never get back sitting in a branch manager's office explaining that she was a widow trying to simplify her finances. That is not a legal problem. That is a completely unnecessary human problem. 1 wire transfer per account, 1 cashier's check, her bank statement as documentation. It would have taken 30 minutes total. Here's what most retirees don't know. The 1 sentence that closes every one of these conversations at the teller window is, "These are my personal savings being transferred from my account at another institution." 1 sentence, said once. Don't add to it. Now, before I get to the documentation, I need to talk about the piece of this that most financial advisors get completely wrong. Thing number 4. What your advisor probably told you and why it's backwards. I want to be careful here because I'm not saying your advisor is incompetent. I'm saying that banking compliance law is not most advisors' specialty, and the advice that gets passed around in that world around the $10,000 rule is often the exact opposite of what protects you. The advice most retirees receive sounds like this: keep your transactions small, split it up, don't give the bank a reason to ask questions. That advice, delivered with good intentions by someone who genuinely thought they were helping, is the advice that caused Carol's 4-month account freeze. It is the advice that caused Robert's compliance review. It is advice that describes the crime, not the protection. The actual protection is the opposite. Make the transaction as large and as singular as possible and document it completely. Take Margaret, 69 years old, retired teacher in North Carolina. She inherited $28,000 from her mother's estate, cash from the sale of a small piece of property. Her advisor told her to spread the deposits over a few months. She called me instead. Here's what we did. One deposit, the full $28,000, accompanied by a copy of the estate settlement paperwork, a letter from the estate attorney, and the property settlement statement. The bank filed a CTR. It went nowhere. It will never go anywhere, because every piece of documentation is sitting in a folder answering every question before it gets asked. Let me put a dollar amount on this so you understand the stakes. If Margaret had followed her advisor's original suggestion and spread that $28,000 over 4 months in $7,000 increments, she would have made 4 transactions all landing under the reporting threshold in a tight window. That pattern is textbook structuring. If it had triggered a civil forfeiture, which it legally could, recovering that money could have cost her $5,000 to $15,000 in legal fees, even with a complete win. She would have kept the money, but lost the legal costs. And she would have done it to herself, trying to be careful. Here's what most retirees don't know. The CTR report is not your enemy. The structuring charge is your enemy, and your advisor may not know the difference. This next one is the one most people miss entirely, and it's the one that has the longest tail. Thing number 5. The documentation you need to keep, and exactly how long to keep it. The paperwork question. I get this one constantly. What do I save? For how long? In what format? Here is the exact answer. Built for retirees, with no gray area. First piece of documentation. The source document. Whatever explains where the money came from before it hit your account. Bill of sale if you sold property or a vehicle. Gift letter if a family member gave you cash. Estate settlement paperwork if it came from an inheritance. Transfer confirmation if it was your own money moving between accounts. Your CD maturity notice if a CD funded the deposit. This is the one document that closes the conversation immediately if anyone ever asks. Second, a bank statement from the originating account showing the balance before the transfer. This proves the money existed before it arrived. It makes the trail clean in both directions. Third, your deposit receipt or wire confirmation. 30 seconds to save it. Keep it physically or photograph it with your phone. This is your timestamp and your proof of one single transaction, not multiple. Fourth, tax return consistency. If you sold something for a gain and deposited the proceeds, that sale may need to appear on your federal return, particularly if it was real property, collectibles, or a vehicle that may have appreciated. When your tax return and your bank record tell the same story, there is nothing to investigate. When they don't line up, that gap is where problems start. How long to keep all of it? Minimum 3 years from the date of the transaction. 6 years if the amount is large or the source is complicated, such as an inheritance or a property sale. If you were ever involved in a transaction that got flagged or reviewed, keep it indefinitely. And the final rule: if your bank ever sends you a letter asking about a transaction, answer it once with your documents in hand and stop talking. Do not call back with additions. Do not write a long email with context nobody asked for. One written answer, your documents attached. If the question escalates beyond a routine compliance inquiry, do not say another word without a CPA or tax attorney present. That is not paranoia. That is exactly what the system expects you to know. Let me give you a real example of how this plays out when everything goes right versus when it goes wrong. Take a couple Geos, Jim and Beverly, both 68, retired in Florida. Jim gets a Social Security check of $2,100 a month. Beverly gets $600. They have a small pension of $800 a month from Jim's 22 years in manufacturing. And Jim's father passed last year, leaving them $47,000 from the sale of his house. Cash proceeds from the estate, legitimate, fully documented. In the wrong scenario, following bad advice, they deposit that $47,000 in 5 separate deposits over 6 weeks, all under $10,000, spread between 2 branches. Their bank's automated system flags the pattern within 3 weeks. They receive a written compliance inquiry. It takes 2 months, 3 trips to the branch, and 1 very tense phone call with a compliance officer to resolve. The money is theirs. They get it. But they are shaken, embarrassed, and spent February of their retirement sitting in a bank instead of living it. In the right scenario, 1 wire transfer, the estate settlement paperwork in hand, 1 sentence to the teller, the bank files a CTR. Jim and Beverly go home. The record sits in a federal database, completely inert for the rest of their lives. No letter, no call, no review. That difference, 1 transaction versus 5, is the entire ball game. Now compare that to someone who says, "I'll just keep the cash at home." I understand the logic. I do not recommend it for a single reason. When you eventually do deposit that cash months or years later, you no longer have a clean paper trail connecting it to the estate. The money exists. The source no longer does. That gap is 100 times harder to explain than a properly documented wire transfer. That does not mean Jim and Beverly's situation is wrong for everyone. If your inheritance comes with contested estate claims or legal complications, the documentation process is more involved. But the principle is identical. 1 transaction, full documentation, clean paper trail. That is the whole answer. Let me bring it all together. Here are all 5 in order. 1. The $10,000 CTR report is not the problem. It is the structuring, breaking up deposits to stay under the threshold. That is the federal crime, regardless of whether your money is clean. 2. The 3 transaction types that put retirees most at risk are personal property sales, family cash gifts, and account consolidations after a life event. All 3 are common. All 3 are safe if handled correctly. 3. Moving your own money between your own accounts is not automatically safe. The bank system reads patterns, not intent. Move it in 1 wire transfer per account. 4. The advice most advisors give on this topic, keep it small, split it up, is backwards. 1 large, fully documented transaction is always safer than multiple smaller ones. 5. The documentation that protects you is the source document, a bank statement from the originating account, your transfer confirmation, and tax return consistency. Keep it for a minimum of 3 years, 6 if it's complicated. 5 things the IRS and your bank's compliance system expect you to know. Most retirees know 0 of them on the day they retire. Every single one you miss makes a routine transaction riskier than it has to be. This is Frank Dalton. If this video helped you, hit the like button right now. It takes 1 second and it puts this video in front of more retirees who are making these transactions right now without knowing the risk. If you're not subscribed, hit subscribe and turn on the bell. The video I'm working on next breaks down the single most misunderstood rule about inherited IRAs in 2026. Specifically the 10-year rule and the 1 timing mistake that forces a massive tax bill in year 10. You need to see that before you touch an inherited account, and if you know someone who recently sold a property, received money from a family member, or is moving their savings after losing a spouse, send them this video today, not next week. Today, because they may already be planning a transaction right now that they think is safe and isn't. Drop a comment below. Tell me your state and what kind of cash transaction you deal with most: property sales, family gifts, or consolidating accounts after a life event. I read every single one, and the situations that come up most in the comments become the next video. So if your situation is a little complicated, put it down there. It might be exactly what someone else needed to hear. I'll see you in the next one.